In this episode, I continue with part two of my interview with Mark Seed, founder of the popular personal finance website, My Own Advisor. Mark is on a journey to achieve financial freedom and is currently making over $40,000 a year in dividend income. In this episode, Mark talks about how he's investing in today's economic climate and what advice he would give to his younger self. Hi. My name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Let's continue with part two of my wide-ranging interview with Mark. Conventional wisdom tells us, and it's been ingrained in my head for years, is when you're younger, you want to invest in equities, and as you get older, sell off the equities and start moving towards fixed income. So bonds and GICs and term deposits. Are you going to be doing that as you get older, or do you have a different approach to when you hit the retirement age?
Yeah, I mean, I can come back and tell you in a couple of years, I think. My approach may be a little bit different, but maybe other people, around our cohort in terms of Gen X are thinking of the same thing. So I'll give you some more insights, and I do have some articles on My Own Advisor about this. But my plan is to essentially live off dividends per se, or distribution. So I'm not going to be spending the capital, as we alluded to earlier. I'm not taking the price appreciation and selling that off, or I'm not making my own dividends in terms of selling the gains that I've had. I'm basically just going to live off the distributions and the dividends that the stocks or ETFs provide my portfolio, and I'm going to supplement that income stream with some part-time work. So that is our goal in the next few years. We'll work part-time, full-time for the next little bit for sure, for my employers listening. But work part-time in the coming years, live off the dividends. We'll be too young for CPP, be far too young for OAS. I'll be too young to collect any pension. And so that's our plan. I won't probably own any bonds entering retirement. And I understand why there's a flight to more fixed income safety right up until retirement, just because you just don't know what's going to happen. There could be an epic crash and correction and so on. But because I'm working part-time and I'm going to be having maybe a longer transition to any sort of full retirement, and I'm not feeling the need to sell my equities, I feel I'm probably going to enter semi-retirement, if you will, with some sort of cash wedge and just being in 100% stocks and equities that I'm already in. The only thing I'll do probably, Canwell, is I'll probably increase my cash position. So like I'm thinking about having like even up to a year's worth of expenses just in cash, or a high interest ETF or something, that if the stock market were to shut down for 12 months and I didn't have a part-time job at all in my planned semi-retirement, I could basically live off that for an entire year. So it's something I'm thinking about, but because I'm having a few different levers to pull with the part-time work, the portfolio income stream, I feel that's enough margin of safety, and that cash wedge, that cash buffer will be kind of that extra layer. So that's what I'm thinking about. Full-on retirement, honestly, different story. Maybe I increase my GIC position, but then again, I'll be older. I'll have CPP income, I'll have OAS income, hopefully I'll have pension income. So all that fixed income stuff that I would need normally in asset accumulation years, a mix of equities and bonds, I'm going to get it in my portfolio anyway. So the short answer is I'm not really seeing a massive shift to happen. But, talk to me in a couple years and maybe I come back and say, wow, another black swan event happened and it caused me to go more fixed income. But right now I can't see it.
Yeah, no, that sounds like you've got redundancy built into this your plan, which is great, because you should have a plan regardless of your age. Even if you're in your 20s, 30s, or 70s, you should have a plan of how are you going to support yourself and support your family with income somehow, right? We can't all work to, or most people don't want to work till they're 95, right? Or can work till that length of period of time. So you want to have dividend income coming in. And you've talked about this on your blog. So can you share with our audience, where are you today with your annual dividend income? have that number on your site, right?
Yeah, I do. So they can follow my monthly dividend income updates. It's more of a projected annual dividend income, or moniker is Patty, right? So projected annual dividend income. Um, I'm optimistic from our RSP values and from our taxable accounts. We have TFSAs, but I only report certain information for other reasons, privacy reasons, other reasons. But I'd like to think we're doing pretty well. I think we're probably averaging maybe close to 3,400 a month from the RSP accounts and the taxable. So that's going to be a nice base um, to have some sort of semi-retirement lifestyle. And then obviously we'll need to do a little bit of part-time work or work in some capacity to kind of close the gap between all of our expenses. But um, certainly because I'm too young for all the other income streams, the part-time work will occur, and I'm optimistic that'll happen in maybe my 50s. But then by the time I'm older, TFSAs would have grown in value, and then I can turn on that income stream if I wanted to, or I could continue to live off the dividends and distributions, and then other income streams come online like the pension and CPP and OAS and so on. So I think we've got a good base. There's more to go, but we're really happy about what we've built and kind of our low cost DI way of doing it. So yeah, folks can definitely check out my site. They can just do a quick search, or within the first 10 probably recent articles, you're going to see at least one maybe monthly dividend income update, and they can dive in and look at the math, and they can ask any questions on the site. I'm happy to try to answer anything possible that folks want to pepper
Yeah,
me with.
that's amazing, right? Because you've put that on the site. It's been there for many years, where you share your progress, and that is so inspiring for everyone. It's inspiring for me too. When I see it, and I'm like, okay, good. There's hope here, because like we talked about early in this interview, in the beginning, when you start investing, it's going to be small. The dividends are small, right? They're like 87 cents a share. And then you only get that after a year. You got to hold on to the shares for a year to get that 87 cents or $1.05, whatever it is. And you look at that number and you're like, how am I going to retire off of this? Like, I can't, this doesn't even cover my mortgage. Um, but it starts off small. And like we talked about, over time, as you start reinvesting the dividends, as you add more money, as the dividends grow, then it starts to eventually sort of snowball, and eventually it's going to get bigger.
It does. I mean, when people look at some of the articles on my site, you're going to see, going back 10, closer to 15 years, when I had the genesis of the blog, that number was like 1/10 of that value, what I just told you, right? Like, it wasn't 3,400 a month. It's like less than 300 a month. But again, time, savings rate, and just keeping our costs low, and being quite choosy about where and how we invest our money has literally paid off in dividends, right? So it's just the incubation time has been huge, and certainly a high savings rate, the ability to max out a TFSA in recent years, or our RSPs have been massive. I don't discount that. But regardless if you're saving 50 a month, or if you're able to save 500 a month, which is quite a bit, the facts are is that those numbers will compound and will add up, and it'll be your savings rate in time, and ideally a decent rate of return that's going to grow that curve, quite rapidly.
Yeah, absolutely. You have to have the discipline and the patience, right? The discipline to stick with it. Don't jump from one approach to another, and tomorrow I'm going to sell everything and just put everything in crypto, because that's what everyone is doing. And then 6 months later, jump onto something else. So the discipline to stick with it, and the patience that this is going to take time. This is years and years. We're not talking about day trading. We're not talking about turning $100,000 into $1 million in 1 week, right? So it does take time to get there.
It does. And just a bit about some of the folks I interact with, whether it's the Canadian Money Forum, some of the sources like I said, or the readers that have been following now for some of them the better part of well over a decade. Some are younger, some are older, but the older folks, I mean, they can attest. They said, I was like you. I started out doing the same thing 15 years before you, and I've made my share of mistakes. I shouldn't have bought a house at this time. I probably shouldn't invest in this certain product. I probably stayed in this high price mutual fund for too long. Everybody's had, some sort of money lessons learned, but the common denominator is that they've learned from them. They've been wiser for them. They pay attention to what they invest in now and why they invest it. They try to limit their mistakes. And they've been hugely successful, some of these people. They've been able to retire without a workplace pension, and in some cases have more income and money that they can spend in a year, not because they're making that much, just because they make enough where it just covers their annual expenses, right? They're making 60, 70, $80,000 in dividends, and then on government benefits, they've only had to spend $5,000 a month, but now they have 6 or 7,000 coming in. So they're in a massive fortunate position by just having the long-term discipline. Again, whether it's stocks, baskets of ETFs, doesn't matter in my opinion, but having a long-term plan that they've been able to stick to has been, game changing and retirement changing for them. They were able to retire a bit sooner. They were able to travel to different places. They were able to help out their kids. They were able to afford a cottage or a boat or whatever they wanted. And so lots of different ways to invest, but ultimately the discipline and the time is huge. And it does take those two ingredients.
Yeah, absolutely. And when it comes to personal finance, I mean, I like to keep it really simple. So at the end of the day, you want to be spending less than you're earning, right? If it's the other way around and you're making this much every week, but you're spending this much, this is just not going to work, right? So you need to make sure that you're earning this much money and spending a little bit less. So then you have that to invest for yourself and for the future.
Totally. Ideally, you grow the gap, right? You can make more money and keep your expenses somewhat constant or relative. But if you can start with the gap and continue to grow the gap, that's ideal. But, these are tough times too, right? I mean, inflation's running hot. There's a lot of things that are more expensive in 2023 for a lot of us, all of us, than 2022 or 2021. So it's not easy, but that's where you do have to have that long-term plan and long-term vision.
Yeah, absolutely. And you're right. Times are difficult and challenging, and we've just come through. COVID was unprecedented. Like nobody ever expected this to happen. And then last year we saw the Federal Reserve in both the banks in Canada and the US increasing rates, right? There was so many increases. 5 or 6, 7 increases last year?
Oh, yeah.
I lost count after a while.
Yeah.
Now the Bank of Canada, their most recent meeting did not raise the rates. So they just kept it the same. The inflation numbers I was reading the other day, I think it's a little bit lower now. We were at 7%. Now we're at sort of 5.6, which they still think is high. And now folks are saying that there's going to be high unemployment rate. Maybe things are going to slow down. The economy is going to slow down. And you just listen to the news. It's just negative news everywhere. Just, oh my God, this is what's happening in the world. So Mark, have you changed your approach to how you're investing?
I actually haven't. I mean, we're fortunate to have both my wife and I good jobs and relatively stable jobs, so that's been a huge enabler for us. But I actually haven't changed much. We're always mindful where we spend our money, but we try to align it to our values, right? So I guess one quick aside or example is, we do like going out to dinner once in a while. Okay, well, let's still do that, but are there areas that we can cut back on, or do we not need to, spend as much money over here to still enjoy those kind of, treats or freedoms or those types of things? But it hasn't changed my plan. We hope to still semi-retire in the coming years. I'm still trying to sock away and max out TFSA room as much as I can. I'm still trying to contribute to my RSP for the tax deferred compounding that we've talked about tonight, and obviously to lower my taxable income in the current tax year, right? So those are two huge benefits. But other than that, we're really trying to live our life and enjoy some of the freedoms and some of the things we do today. So yeah, maybe we won't go out to dinner as much, or maybe have to curb and delay some gratification here and there. But we've tried to work really hard and be quite disciplined over the last 15, 20 years. So we're coming to a stage in life where, mortgage debt is almost non-existent. We don't have any other debt on the books. So everything we make is for us to keep or spend. But this is what we've been working for. And again, it does take time and effort, but I haven't changed yet. And if certainly inflation stays hot and very high for the coming multiple years, I'm not just talking about 2023, but through 2025 and 2026, certainly we could probably see a lot of changes in my life, your life, other people's lives. And so we'll have to cross that bridge when we get to it. But I do acknowledge it's not easy. And gosh, you go to the grocery store, like what isn't up in price and what isn't double the price that it used to be 2 years ago. So you do have to make some smarter shopping decisions, and you do need to ratchet things back a little bit more. But in terms of it changing our financial independence plan or our freedom plan, or whatever you want to call it, no, we're still on track.
So, Mark, we've talked about your site, My Own Advisor. I'm going to put a link to it in the description below. I encourage everyone to check out that website. It is a wealth of information going back, like you said, 15 years. So, Mark, you've learned so much. You're self-taught. You've learned all of this yourself, DIY investing. If you could go back in time and speak to your 21-year-old self, what advice would you tell the younger Mark when it comes to investing?
Yeah, great question. I would be wary of anybody trying to sell you a particular fund product or kind of an insurance product or a service. And it's not that all mutual funds or different financial products are bad. It's not to say that whatsoever, but understand where that person's compensation is coming from, right? So, and that's not easy, right? As a young 20-something, you think you know everything, but you're probably a little bit of knowing not too much or nothing, right? So, a lot of unbridled enthusiasm. But I think, to talk to my younger self, just understand or better understand what is the compensation model from who is selling you something or offering you something or giving you something. And there are lots of companies and fintech and services out there that are doing the right thing and are being entrepreneurial and trying to help people. And that's not about that. It's more about, the big marketing financial machine that is personal finance and investing. I think there's a lot of piranhas out there that you have to be watchful of. And I think it would be to be a little bit more critical about how people are being compensated for their product or service. That's what I would, and that would allow you to go down a whole set of other lanes, right? In terms of, should I buy this fund? Should I invest in this mortgage insurance product? Do I understand why this broker or salesperson is, saying to buy this stock or penny stock or what have you? So I think there's a lot of pitfalls you can avoid by just truly understanding people's motivation from the sales, products, or services side of things. And a lot of people doing it well, and a lot of people being honest and transparent about it, but I think a lot of people not so much.
Yeah, and what we're talking about here, just in this podcast, and what you talk about on your site, and I do the same thing with Simply Investing, is educating folks on how to invest. I don't know how you feel about this. I'm so passionate. They should be teaching this stuff in high school to everybody. It should be like mandatory.
Yeah, there's a big gap in the curriculum, right? Like you don't young folks today, I mean, probably a lot of them have credit cards, a lot of them have cell phone bills. But how does it all work, right? Who's working for your best interest? When you being sold, or when are you the product? So yeah, there's a lot of that. There's a lot of those potential teaching moments or teachable moments, but unfortunately, people go through those teachable moments, not unlike what I did, hopefully less and less over time, by making some mistakes, and some of them can be quite costly. And I think just understanding where other people's bread is buttered, or, how am I paying for someone else's yacht and not your own? I think understanding those types of concepts are really important. But yeah, I absolutely agree at the high level. Why this is not taught more in schools, why this isn't on the curriculum more. It unfortunately falls to parenting and hopefully by chance in some cases. But hopefully things will change for the better in the future. But when in doubt, they can always head on over to Mine Advisor and see all the good, bad, and in between that I've done. So.
Yeah, absolutely. Learn from our mistakes. Like you and I are talking about this. We have our own blog. We talk about our experiences. There's no need for people to reinvent the wheel. Learn through I made a lot of mistakes, a lot of trial and error. And no fault of my parents. They were never taught any of this. So when I graduated, I got my first job. I was told, hey, put your money in mutual funds and put it all in RSPs. So I spent 10 years in mutual funds, MERs. I look back at it now, kept all the statements. Some of the MERs were 3.5%, 3%, 2.5% for 10 years, just stuck in there. And I thought that was the right approach. I was like, this is what everybody does. This is what my parents did. And that's what they told me to do. So education is so key. And I agree with you. Like, yeah, check out Mark's website, check out Simply Investing, whatever you need to, and educate yourself first on
and
you spend a penny.
Exactly. And ask the tough questions. And even if you don't invest like I do, which you may not, or like you do, or like other people do, that's okay, but it's an informed decision, right? You can say that's not my cup of tea. It's not my risk profile. I disagree with the benefits, or I think the risks are too high, and that's totally okay, right? And there's lots of different ways to invest. There's lots of different risk appetites when it comes to investing, and ultimately, once you figure thyself out more about what makes you tick and what motivates you, or makes you more fearful in some cases, that's where you're really onto something.
Mm-hmm. Yeah. So, Mark, tell us about your other site now. So you've got a cash flow site. Can you tell our audience a little bit about that and what do you do there?
Yeah. So I started that site with my partner, Joe, about a year and a half, 2 years ago. And what we wanted to do is something a little bit different in that we want to make it very educational, but kind of more like beginning to end, right? So, and we've put various stories on that website, cashflowsandportfolios.com. Some of them are for beginner investors, but our audience, I would say, is more on the asset accumulator side, but it's also on the asset decumulator side, right? So it's taking a more holistic educational lens about, now that you have some cash or you have some cash flow coming in, how do you manage that cash flow better, right? So it is all about trying to optimize taxation. As a DIY investor, it's also looking at some of the lowest cost products, i.e. ETFs or what have you, that are on the market. But for the asset decumulator, it's also profiling case studies, and it's also highlighting, now that I've built up my portfolio, I'm in my late 40s, early 50s or 60s or what have you, and I'm looking to actually enjoy the fruits of my labor. How do I draw this down in the right order, right? How do I preserve capital? So I've got the cash flow, but I also need to manage the portfolio, right? I want to preserve the capital. I may want to create generational wealth for my kids. What are some of the investment vehicles or things I can be thinking about for that? I want to avoid paying too much tax as I draw down my RSP. When should I consider tapping my taxable account? Should I be taking CPP sooner than later based on my situation? So not only are we educating people through case studies, we're also providing some services on our site as well, where we will take people's information for a low-cost fee model structure, and we'll provide them with some financial projection reports based on software that are basically tailored to those questions. So if you want to ask us about, here's my my whole ball of soup or my whole kind of can of soup in terms of what I own. Should I take it at CPP at 65, 60, or even 70? What's my estate value going to be? So on and so forth. So we go through all those types of questions with you, and we tailor those reports based on your needs. So that's been a great, it's been a great venture for my partner Joe and I personally, because it's kind of where our headspace is at. But we also find we're helping many people, whether you're in the FIRE community, whether you're Gen X like us, thinking ahead about the next 5 or 10 years, or people that are, early boomers or late boomers, they're pulling the plug real time, and they want to know, is my pension going to be enough, or is the ability to live off dividends going to be enough, or my goodness, what's the estate value going to be if I pass early, and so on and so forth. So lots of considerations, lots of math, but we definitely take clients' inputs, assumptions, inflation, taxation, what have you. And yeah, we send you some personalized reports, and it's been really fun. I enjoy doing it. And yeah, we think we're biased, but we think it's great.
That's a great service. You're helping folks with so many questions that they have on their mind when it comes to money. And I'm just going to repeat some of the stuff you already said. Am I going to have enough money to live the next, if someone's already retired, they've got another 25, 30 years to go. Is there enough money there? And like you said, if some folks are now thinking about estate planning, how much am I going to leave to the kids? How much is going to go to taxes? So that is all very good questions. And it's great that you're helping folks figure that out, which is fantastic.
Yeah, I mean, it's another labor of love, if you will. It's something that I think is definitely needed. In the Canadian personal finance space, certainly, folks can go to many fee only planners for this type of work, but we have no bias. We have no reason to have any assets managed, under the hood, if you will. We're DIY, basically for DIY people, and so I think we're providing something quite unique and different. And there's really no obligation, right? There's a full kind of, if you're not happy with the services, we would absolutely provide that kind of return back to you. But it's been outstanding. We've helped dozens upon dozens of people over the last couple of years, and we hope to keep running it for much longer. And yeah, check us out at cashflowsandportfolios.com. New content usually every week or so, depending on when Joe and I get after the content and such. But yeah, the case studies are there, great, and we'll continue to do those because I think people can really see themselves when you provide those case studies, whether it's single income, couples just before retirement, couples want to leave the day job and work part-time or pursue van life or whatever it may be, right? People can kind of see themselves in these case studies a little bit. So we'll keep doing those, and we'll try to help on the service side as well.
Yeah, no, that's great. We're going to put the links in our description below for both your My Own Advisor site and then Cashflow and Portfolios. Mark, is there any other place where people can get in touch with you? Or you act, I don't know, on Twitter or Facebook or any other places? Or where should they go if they want to get in touch with you?
Yeah, I mean, Twitter's interesting on a good day, but I am on Twitter. So we tag each other a little bit, I know. But yes, I can be found at My Own Advisor on Twitter. My website, I think some of your readers know, but it's myownadvisor.ca. Folks can find me directly through the contact on the top right, I believe. Send me an email, say hello. I try to, as much as I can, either reply to every comment on the site or at least acknowledge all the emails that I get. It's sometimes a lot to keep up with, but I try to do my best and get back to people as much as I can. And if I don't know the answer, I'll try to point to experts and other people in the industry that I trust and that I know very well. And I'm happy to direct them to different sources if I can help them out myself. And then, yeah, cashflowsandportfolios.com. So whether it's the Twitter, both websites, a few clicks of a button, you can find me somewhere. So.
Okay, that's great. We'll put like I said, some of the links down. Folks should definitely check out the resources. There's a wealth of information there. Mark, I want to thank you so much for taking your time out. I know you're super busy, but sharing your knowledge, your experience, this is certainly going to help our audience. I hope it's going to inspire folks to sort of move in the right direction, whichever direction they want to take when it comes to do-it-yourself investing. So thank you, Mark, for being on our podcast. I really appreciate it.
Awesome. Great to be here. And yeah, let's do it again.